Let's get a market perspective with Nick Nelson, an equity strategist at UBS. Now, Nick, it does seem that actually things aren't getting better at all. We still have so much uncertainty out there. What does it mean for your portfolio? The money that is safer is in equities, or would you also be wary of equities?
Well, look, I think equities are facing two big problems. Firstly, the political issues, and we're seeing that again with Eurozone and the downgrade today in Italy. And the second problem is obviously the macro slowdown, which we've seen in the US, but also other developed markets. So I think when you look at equities, there's clearly a valuation argument here. Equities do look quite attractive, but I think it's hard to see how they rally until you have some relief on the politics and some relief on the macro.
But looking at your latest note, you continue to favour industrial stocks and also some cyclical stocks.
I think on terms of the valuations, what we don't want to have is the consumer cyclicals, the domestic consumer cyclicals. So things like general retail, for example, leisure, and the areas we're more bullish on are areas that are more international, more global. And those tend to be things like materials or industrials to a degree.
But so how should investors actually choose a company? Do you look at management? Do you look at PE ratios? And then also look at what you're saying in terms of industry groups which have outperformed or seen these grey or black skies?
Yeah, so this was the analysis. We were trying to say grey skies, which was a sort of mild recession, and black skies, which was this deep recession. And when you look at that, there are some companies where if you take the earnings down to those levels, they still look attractively valued. So it's some of the energy stocks, some of the material stocks, but it's not the general retailers, it's not the leisure stocks, it's not the consumer cyclicals. They still look expensive.
And so is it stocks, though, that are also exposed to emerging markets more than Western Europe, or would you not really make a difference?
No, I think that's right. I think emerging markets clearly are recovering. I mean, growth in China, having had tightening for the last 9 months or so. Inflation looks like it's peaked in China. Obviously, Brazil cut rates the other week. I think emerging markets are probably better placed than developed markets right now in terms of where they're on the growth cycle. So yes, exposure to that makes sense.
Nick, in general, you know, I spoke to a CEO of Green Tech, a renewable energy company, and he was very clear he's very prudent for the next 12 to 8 months, and then there's going to be a pickup. Should it be the same with investors? If they put money in the market now, do they need to have a strong stomach and kind of ride it through for the next 12 months because there's so many uncertainties?
Yes, I think, as I said, I think the valuations are very attractive, but the problem is the news flow we're getting is political, and it's very hard to forecast how the politics are going to play out, particularly in the Eurozone. So I think investors looking at European equities have to be able to take the volatility. A 1 week, 2 week view, I think that's too short term. We have to have a longer term
But still
view.
play the markets now, or wait a couple of months until volatility subsides?
Well, I think it depends on your time horizon. I think if you have the 6-month, 12-month time horizon, I think it's fine to play it now, because I think that, as I said, I think the valuations really are pricing in a recession, which we don't think will happen. But as I was saying, if you've got a 4-week horizon, it's very dangerous to be long equities right now.
A sector that maybe you would be really staying away from, like banks, seems so uncertain. We don't know their funding, we don't know how much liquidity, we really don't know where this is going to end.
Well, banks are very uncertain, but then again, that's where quite a lot of the attractive valuations are. I think the stuff that I would really stay away from would be the domestic-focused European areas like general retailing, the consumer exposed to Western Europe. Those are the things where I think we'll see the weakness.
All right, Nick, thank you so much. Nick Nelson.